Big tech has taken a hit this year, with shares of Meta, Alphabet, and Amazon all down over 40% year to date. But our next guest is turning it tactically constructive for the year to come. Evercore ISI Senior Managing Director Mark Mahaney joins us now. Mark, always great to get some time with you. Before we get into some of your picks and thinking on the space, as someone that has been covering tech for as long as you have, what has this year been like for you? Some of these declines, many investors have never even seen before.
Well, this is that's right. If you started investing after 2008, this would have been the worst year you'd ever seen. So that's the last year in which you had consumer tech trade off as aggressively as it did in 2022. I mean, there was a series of factors that are all well known now: aggressively rising interest rates, inflation, softening economy, foreign exchange working against kind of the major multinationals. Maybe a little bit of regulatory risk in there. So there was just this really nasty cocktail of factors that came together that really undermined tech growth stocks in 22. I think some of those factors have changed, and certainly it's reflected, I think, in where estimates are and where multiples are. That's why we're more constructive, but we're tactically constructive. I don't want to be too nuanced about it, but we need to be, because softening demand trends are going to mean decelerating revenue growth and pressure on margins for the next couple of quarters. So that makes it very hard for stocks to outperform. You have to be very selective to find winners in that.
Can tech rebound without a Fed pivot or at least a pause?
I'm pausing on your pause question. So I guess the answer is no, it can't. But it's the magnitude of the move, and so going from 0 to expectations of 4% plus, 4 to 5%, like that's a massive move. And going from here going forwards, I just don't think the interest rate shock is going to be as great as what we had this last year. So that's sort of the answer to your question. I think if rates keep rising and the Fed remains hawkish, it's going to be very hard for growth tech stocks to materially outperform. I don't think they would underperform in the way they did this year. So maybe that's the right answer to your question, Brad.
Mark, are some of these tech stocks, these big cap tech names, second half 2023 plays? Because you would have to think comparisons year over year, sales earnings will be much improved, and we might finally get that reacceleration in growth rates.
Well, that's the hope that's in the market. And so and that's kind of how we're framing some of these names, like especially Amazon and Google that we look at. I think Facebook, the story, the setup on the stock is a little more interesting for the first half of the year, just because, look, you need to, we've got softening demand trends across the board. What you need are companies that are taking cost actions. They got to tighten the belt like all households do. When revenue trends weaken or income trends weaken, you tighten the belt on costs. Facebook did that with a 13% RIF. Amazon and Google haven't done that, especially Google hasn't done that at all. So that's going to cause problems for them in terms of they're going to see more margin pressure than I think is in street estimates. You got downside risk there. Amazon's also going to have some issues. I think they probably need to get a little bit more aggressive on costs. So yeah, I think for the mega cap names, it's going to be tough. Those aren't in my top picks, except for Facebook. The real top picks for me going into this next year for a variety of reasons are Netflix and Uber.
You mentioned Amazon, Mark, real quick on that name as well. Tough year for them. Notably, how much time do you think Andy Jassy has here to get things correct?
Oh, I think he's going to have a fair amount of time. So what we all need to ask ourselves is: are the challenges these companies facing, are the challenges that Amazon's facing, are they structural or are they cyclical? And structural, is there something really fundamentally changed about online retail? No. Cloud computing? No. Or the new competitive dynamics? No, I don't think so. Those are all highly competitive spaces. But the advantage that Amazon has is that it's the leading online retailer. And I think at the margin, they're gaining share. Cloud computing, I think they're maintaining share. They still got this great product mix shift or revenue mix shift towards higher margin, faster growth businesses, advertising and cloud computing away from retail. So I think the core thesis on Amazon is well intact. It's just that it's fully exposed to all of the consumer softening spend, especially in consumer discretionary items, and then inflationary pressures. And the one that's really going to persist from earlier this year are the higher wage costs, and they're going to have to scale against that. So it's going to take time for the Amazon ship to kind of right itself, but it will right itself. And I think if you're, depending on how long term your time horizon is, if you're willing to look out more than a year, I think Amazon's a good price point right here. I think it's at a 5-year trough multiple. But if you want to perfectly time it, which is probably not a good thing to do, but if you're trying to do that, maybe you're waiting until a little bit later in 23 to do that.
And so with that timeline, does high growth